Welcome to Chapter 2 or Episode 2, where we will hop over liquidity, turtle soups, and everything which I just told you in Episode 1. So let's start off with liquidity. In trading, liquidity refers to how easily an asset can be bought or sold, so the volatility between the correlations of the pair, either EU or GU, or the combination with Dixie. High liquidity means there are many buyers and sellers, allowing trades to be executed quickly with minimal price movement. So big expansions, you want to catch the manipulation and then wait for an expansion. Low liquidity, on the other hand, can result in larger price fluctuations and difficult entering on exiting trades. So consolidating markets, because then you just trade from liquidity pool to liquidity pool or from one side of the range to another. In trading, liquidity is crucial for smooth price action and efficient order execution. Okay, so low resistance liquidity, two nice setups here, is considered active when liquidity grabs occur within a price swing. So you have a premium and a discount area, or just your regular price swing, and liquidity grabs occur within this swing, but there is no clear directional bias or key area providing you a definite signal or an way to look at market. In such conditions, the market lacks strong conviction, making it challenging to identify a clear trend or trading opportunity. So trading the kiss of death, which we will later on get into, or trading internal liquidity is difficulter than trading high resistance liquidity, which is referred to a critical point where significant levels are expected to be liquidated or potentially broken. At these levels, we see to observe the low that broke the high or the high that broke the low, with the candle close confirming the breakout or maybe the reversal, and this provides confirmation that the trend has likely reversed or shifted direction or maybe even continued. So you have these two types of liquidities. The easiest type of liquidity is the daily liquidity. This is the daily time frame. Previous day highs and lows represent the most straightforward liquidity targets in the market. Either you turtle soup or you break out of it. 90% of you may have heard the candle close theory, where you can identify the daily bias. Well, it works, but not 100% of the time. Nearly every day there is a notable liquidity purge on a daily candle. As you may look into the daily chart, every single daily candle, well, most of them get liquidated. Often on one or even both sides. Inside bar candles are rare, but when they occur, they tend to hold even more liquidity. I want you to look at October 7th or October 8th. You can see Friday from the big rangy candle, and Monday and Tuesday just inside bar candled. It is crucial to capture this liquidity and wait for the candle to close accordingly. And by the way, the pair is EU. I only trade EU. Everything you see is EU chart. Allowing for more strategic entries either at the discount for a buy or at the premium for a sell, ensuring optimal trade positioning. You may also recognize here you can instantly add on and maybe even look at IPTA and the previous things that we learned in episode 1 and add them to your understanding. Highs get rejected, lows get rejected, lows get broken, highs get broken, depending on the bias. You can still hop down lower. You have your key areas, you have internal liquidities, you have external liquidities, you have swing lows, swing highs, everything in combination, which we will later on get into. And this will be a crucial thing in episode 5 and maybe 6. Here you can see clean liquidity patterns. One of them is a CISD, and yes, a CISD, change in state delivery, is also just considered to be a liquidity grab, because you falsely induce above an old high or below an old low, and then you candle close the opposing end, and then you can trade a reversal or, I don't know, retracement. Trendline liquidity, which 90% of you may have heard of, where 90% or a lot of retail traders trade breakouts or support or trendline traders, which is complete bullshit, because you know as a trendline trader that this is liquidity. So why would you want to enter there for a buy if you know this could get purged? We know we don't trade that. We know this is liquidity. We know it may or may not be a nice area to target. The W or M pattern, or double bottom, double top, double high, whatever, is also just liquidity, where markets, and now bear with me, the first low is a nice normal swing low. The second low takes out a lot of positions already because they may be equal, they may not be equal. If they are equal, then spread 99.5% of the times will take out a lot of traders, because the brokers are allowed to manipulate the positions if it's with spread and in market delivery. So a lot of people will get stopped out eventually, even there, even though market never dug lower than the first low. But still, this acts as a liquidity pool, because if you have zero spread, or you simply trade your own funds, or you are a hedge fund, then you don't have spread. You simply are one of the market makers, but in smaller positions. There you can see or anticipate a lot of volume. And then there is the range. Range trading is one of my favorite, because it's so simple nowadays. You simply trade from one end of the range to another. Okay, these are the 4 most common methods through which the market engineer liquidity, taking it before moving to the opposing end of the range or trading away from it. As we know, market cannot go from a consolidation or a range to a reversal, so 99% of the times, or 90% of the times, or maybe even just 80, but still in a high probability, you will see a false breakout or just liquidity grab, and then a nice shift in state delivery. CISD events are often just liquidity grabs from key swing points. Mark that, okay? The underlying mechanics are straightforward. There are always orders resting above and below each candle. Every candle is a range, which is creating areas of interest for price movement. We also have internal and external liquidity. Some of you may have noticed. Internal liquidity is defined by the fair value gap, and the external liquidity is just defined by swing highs and swing lows. When external liquidity is taken, we can target internal liquidity. Same with internal liquidity. When an FVG is tagged, an old low or high becomes our new target. Go to EU, Euro USD, go into the weekly time frame and look at October 1st, 2nd week. You see internal liquidity to external liquidity. Internal to external liquidity, the relationship between those two, of internal and external range liquidity, and how they interact is crucial, okay, for understanding where the market is likely to move next. Combining this with the daily liquidity concept gives you clear bias. Maybe not for every day, but you don't have to take trades every single day. Understand that. Get it in your head. Mastering this dynamic is foundational to developing anticipatory skills for predicting price movements and identifying where the market is drawing liquidity, or where it will most likely head to next. The higher time frames are more dominant, so if you have a weekly fair value gap which gets rejected or maybe reacted from, whatever, then your 4-hour levels and shit like that gets invalidated. Okay, for the monthly levels, you can go down to the daily structure once you see internal or external liquidity get hit. You simply go down then to the daily and you can wait for a CISD. On the weekly time frame, you can do the same thing for internal liquidity and external liquidity areas which would get hit. You can hop down to the 2 to 4 hour time frame and wait for your CISD. And one of the most crucial things, and hopefully the most interesting, which we will learn in episode 5, is the daily internal external liquidity, daily model, whatever you want to call it. For the daily levels, you'd simply hop down to the 5 to 15 minute, I prefer the 15 or 10 minute structure, and once you see it hitting an internal or external liquidity area or key area, you simply wait for your CISD, an entry, and then placing a trade. Simple as that. Applying this understanding across the monthly, weekly, daily, and 4-hour timeframes is the key to developing a reliable daily bias, okay? There is no daily bias thingy. We will get over that later, but there is no one specific daily bias concept. There is no ICT concept that will teach you that. I can't teach you that. It's intuition combined with knowledge, combined with technical edge. By analyzing liquidity dynamics at these multiple levels, traders can gain a clearer perspective on market direction and enhance their ability to make informed trading decisions. Okay, you have to understand the liquidity dynamics behind that. Now we will hop over the ICT kill zones. Most of you have heard about them in my previous video, Mastering Candle Range Theory. We have Asia, London, New York, and Midnight Open. These are the 4 most important sessions that we are going to talk about. There are some macro timings, which I don't mention because it's too much and you don't need it. If you want to learn it, go study ICT. It's hella boring and you won't find it because it's randomly in a random video, which is randomly 1 or 2 hours long. And it's not needed to trade every single macro move every single 5 to 10 minutes. That's just overtrading, FOMO, and greed. These 4 will definitely increase your trading skills and definitely increase your win rate if you stick with those, because the Asia range model is a whole model where a lot of traders and a lot of gurus also sell a whole course around. The London model is simply the 2 to 5 a.m. range, or market shifts, liquidity grabs, movements, Judas swings, which we will go over in this video and may have already learned. New York range is from 8 to 10 and the midnight open is always 00.00, so just midnight open, 0 o'clock, nothing, midnight. The Asian session can occasionally present an optimal trade entry opportunity, okay, so occasionally, offering a potential 15 to 20 pip scalp. If you measure it, forex pairs will most likely give you something around that, maybe even bigger movements if you trade GBP pairs or like JPY pairs, because JPY pairs tend to be more volatile around the Asia session because there are Asian, Korean, and Chinese pairs, and that's when the banks are active. The London session frequently provides you optimal trade entry setups with scalping opportunities ranging between 25 and 50 pips. Some of the times you will have CPIs, some of the times you will have no news, but just high volatility of the New York's or London banks, and also European banks coming into the market and Frankfurt banks pushing market in a direction. In the New York session, setups typically offer you 20 to 30 pips, so something around like London, just smaller retracements, pullbacks, or whatever, and with the key time to monitor being 9 a.m. for potential price movement and market shifts, which we will get into in CRT. Here you have 3 manipulation times from ICT specifically, and also me, which will correlate perfectly with CRT, which you may have already looked at or learned. If not, then that's totally fine. We will hop over that in a few minutes. And I will also link you the video of the detailed 1 hour 40-minute course of CRT down in the description. So smart money operates in structured quarters. We may already know that, which each trading day having a fixed opening and closing time, and the London session often sets either the high or the low of the week or of the day, while the New York session frequently defines the daily closing price or the weekly closing price, effectively capping off the day's market movement. Understanding this timing dynamic is crucial for identifying key market shifts and entry opportunities. As I've already said in episode 1, nothing that is coming out of my mouth is random. Okay, everything has its correlations, and you will soon understand if you watch these videos at least 3 times why everything in this course correlates perfectly together, and I try to explain it as simple as possible because some of you may not even understand it after these videos. But then I can't help you. I can just tell you, stick with it. Okay, it's very easy and it should be easy to understand. That's why it's boring. Okay, Do the boring stuff for the longest and you will succeed. The first manipulation time or liquidity grab and manipulation time is from 2 to 3 a.m. So you here see at 2:30 liquidity grab, which may also indicate you a Judas swing for those who are a little bit intermediate. New York's manipulation time is ranging between 9 to 9:30, maybe even 9:15 or 10, maybe sometimes 8:30, but we will hop over that later. And also for the afternoon session, you have a manipulation time which frequently occurs between 13:30 to 14 o'clock or 2 p.m. in this case. Everything I tell you about timings is New York timing. It's UTC-4 on TradingView in New York. Time levels. There are specific times during which the high or low of a given candle will form, either monthly, weekly, or daily, which we'll hop over. Since every candle presents a range and represents a range, gives you the range and shows you a range, acts as an open high low close, open low high close. Certain days will see consolidation, while others will experience market manipulation or expansions. Understanding the distinction between these conditions is essential for identifying key moments or of price, okay, when movements with the move of a specific candle. So for monthly levels or the monthly candle, the high or the low of the monthly candle, and every candle is a range which can be broken down. You have gotten the time frames already 2 times. Will most likely form at week 1 or 2 and then cap off the week with week 3 or 4. Same for the weekly. The high or the low of the week will most likely form at Monday to Wednesday and then cap off at Thursday to Friday. Look at the 10th of October, okay, and try to understand in Euro USD what formed the high and what formed the low. Daily time frame. The daily high and low, or the high and the low of the daily candle, will most likely form at the London session and then be capped off at New York, giving you a small retracement or pullback, whatever you want to call it. This principle also applies to range trading. So if you have a range, which is explained perfectly in CRT Masterclass by me, whether it's the second week of the month, a Tuesday session, or the London session causing manipulation, regardless of the time frame or session, understanding how and when manipulation occurs is crucial for anticipating market behavior within a range. Read that whole thing again, make a screenshot out of this, print it out, stick it to your wall, stick it to your fridge, stick it to your forehead, I don't know, and then learn these things. The picture on the bottom left is also crucial. ICT's Judas swing. We will now hop onto this, which you have heard a few minutes ago. A Judas swing in trading refers to a strategical executed move by larger financial institutions designed to trigger significant liquidity areas. As you see here, 2 examples, I will get over those soon. However, this move often precedes a sharp reversal, as the true intention is to exploit liquidity before shifting the market in the opposing direction. Here, the 2 a.m. Judas, that's what you also saw in the example before at 2:15. The 2 a.m. Judas will occur most likely between 0 and 5 a.m., which indicates a fake liquidity grab to one side and then most likely targeting the opposing end of the range, or even further key areas and liquidity areas, internal such as external. As you see here, you have the Asia range, which is marked by the gray box. 2 a.m. giving you big candles, just big bulky candles going into one direction with lots of volatility. If you go down to the M15, you will most likely see like 2, 3, 4 candles, which are just black, grabbing liquidity, giving you a fake indication of a move, and then you see immediately afterwards a big push to the opposing side, a shift in market structure or a CISD, where you then can enter. We will get deeper into that once we discussed about the trading models, which I personally trade every single day. Every single day is a new opportunity, and there are many pairs out there which can be traded. There's also the 13:30 p.m. Judas, or the 1:30 p.m. Judas called. The 2 a.m. Judas will occur most likely between those times, and the 13:30 p.m. Judas will most likely occur at 1 p.m. to 3 p.m. This is a trading model where you could also use a 30-minute time frame, which we will also speak about in depth in the trading models. Here you see now 3 examples of ICT's turtle soup. ICT doesn't trade turtle soup. ICT still knows how these things work though. Turtle soup is a counter trend strategy that takes advantage of false breakouts. So most of you won't know that, or won't even know that, because it's not a CRT, it's not a strategy, it's just counter trend. It's falsely inducing below an old low, falsely inducing below or above an old high, and giving you a counter trend, a pullback, maybe even just to 50%, or maybe even to the opposing end of the range or higher time frame key level areas. When the market breaks a key high or low, triggering breakout traders or stop losses, the price quickly reverses, trapping those traders. As we've seen in liquidity, breakout traders or trendline traders get trapped. A lot of support resistance traders get trapped, and then we hit the opposing end of the range. ICT traders recognize this pattern and enter trades in the direction of the reversal, using the liquidity generated by the false breakout to their advantage. Here you see the first example of ICT's turtle soup, which is a 1 a.m. turtle soup, okay, simple 1 a.m. model, which I also went over in Mastering Candle Range Theory. The 9 a.m. ICT turtle soup continuation trend, okay. Turtle soup can also occur in a state where we will see a continuation trend, so we can then use the standard deviation. For those who don't know, standard deviation is marking the previous swing high, swing low, and the Fibonacci tool giving you 100, 150, maybe 200% of the additional ranges, which is automatic, to then trade to and have a target, because for continuation trends, you don't have targets. You simply trade within the trend. So if you're bearish, you take sells, as in this picture here, you turtle soup above an old high, looking for sells at a specific time, which is 9 a.m. Listen to that again. And then trading lower. Why did he close the position there? Because that's, I don't know, 150% of the whole swing from before. The 9 a.m. model, turtle soup reversal, is simply just like the 1 a.m. model, but the time frame or the time alignment is a little bit different. Is also explained perfectly in Mastering Candle Range Theory, and will be explained in the future in episode 3 or 4. 9 a.m. ICT's turtle soup, here you see inducing above an old high, forming a CISD, giving you the order block entry, giving you the FVG entry, and then pushing lower. Okay, Cobraclay's turtle soup. I refined ICT's and Romeo's turtle soup candle range theories, whatever you want to call it. In this section, we will dive deeper into the concept of turtle soup and explore the principles behind CRT, so the candle range theory, which is simply another way of viewing markets. I didn't invent anything new. Everything is still the same, but it's just simplified and an easier way to envision the charts and get a deeper understanding and grasping behind what charts or markets could do. The knowledge you've acquired so far will now be applied to gain a broader understanding of market dynamic. So if you haven't watched the episode 1 yet, or not even episode 2, and you skipped all the way to this part because you want to learn about CRT, go back and look at episode 1, and if you watched episode 1, watch it again, please. You will help yourself a lot. Write down everything I'm saying except these fillers where I talk about how important things are. You don't have to write that down. Leading to a comprehensive grasp of my refined candle range theory, which ties everything together in the bigger picture. Here you see how a candle is formed. Every single candle out there. I also mentioned that in CRT, and I want you to look at the video because it's detailed, very good, and it took me weeks to make. Every single candle here is formed the same. Every daily, weekly, monthly, 4-hour, 2-second candle. Every candle forms like this. Every candle is a range broken down in lower time frames, and candles get broken out of or falsely broken out of. The open, high, low, close, open, low, high, close. The open, high, low, close or open, low, high, close structures are key patterns based on the power of 3 model. Okay. In bullish market conditions, a strategic buying opportunity occurs when price moves below the opening of the higher time frame candle. So in the case, maybe digging below Asia low, which is just the open, which you shouldn't trade because it's not your trading time, you should be asleep. Digging below or maybe above Asia, which indicates you as a manipulation, because we know London likes to form manipulations, and then trading in the opposing end of the range. Conversely, in bearish conditions, the optimal selling opportunities arise when price moves above the open of the higher time frame candle, and these principles guide traders in alignment or in aligning entries with broader market structure and trend continuations or trend directions. The open, high, low, close principle is fundamental in trading and is used to analyze price movements over a specific time period, such as a daily, weekly, or even a minute candle. Same for the open, low, high, close. Here you see the open, low, high, close, OLHC or OLHC, with 3 candle as, as an example. Everything ties back to the power of 3. Okay, power of 3 is the candle or 3 candles establishing, or with the first candle establish the initial range, which could be Asia, day 1, week 1 or week 2. And the second candle giving you the typical manipulation and capturing liquidity within this range, closing below the first candle. Okay, maybe London liquidates Asia, pulls back, and then you can look for sells or buys depending on the bias. After this, traders can either enter immediately following a CISD or waiting for the third candle to form, entering above its open for a more confirmed trade setup. This approach leverages market structure and liquidity dynamics for higher probability entries. So go back to liquidity and structure, look at these, combine these together with Turtle Soup and CRT with my pre-written course, which is already out, about Turtle Soup and candle range theory. The first step is we gotta mark our candles. Okay, we mark our candle, which then act as our range. Either Monday is a nice range. In this case, for 10th of October, I don't know. You can still mark Friday, which was 4th, 5th of October, I don't know. And then you wait for simple manipulation. Step 2, you can take your first entry on the candle which forms the manipulation. So either you wait for a CISD after, I don't know, Asia gets grabbed, the first candle gets grabbed, your range gets grabbed, everything is the same. You can immediately enter after a CISD. Or step 3, you wait for the third candle to open and you simply wait for the candle to open, which is a 4-hour candle. So at, I don't know, 9 p.m. or 9 a.m., sorry, you wait for 9:02 or 9:03 a.m. to come above the open, and then you can press sell. Your first target, okay, is 50%, and then also the opposing end of the range. The open, high, low, close power of 3 in combination with the AMD. Study this picture here because it's also pinned in my Telegram. This picture shows you how a candle is formed, shows you what Turtle Soup is, shows you the 2 main times that you can trade in a day. Okay, you don't need more. If you have 2 trades a day and you make wins, that's enough. You have 60 trades a month and 20 days or 10 to 20 trades a week. In this example, you can clearly see a defined market structure. As I've said, offering an opportunity to use the open high low close principle for 2 sell trades on a classic sell day. Okay? By identifying the bearish trend and key levels, you should have executed 2 successful short entries utilizing the OHLC method to enhance trade precision and profitability. 1 a.m. gives you a maybe 2 to 3 a.m. turtle soup, or a 1 a.m. turtle soup coming or inducing or falsely inducing above old highs or above Asia, pushing lower, giving you CISD, and also pulling back into the order block or the fair value gap, giving you a entry if you missed out on the CISD entry, which is the third candle. Okay, if you missed it, you then enter on the third candle, and maybe the second candle will leave you with a nice key area, such as IFVGs, FVGs. If not, then you simply can trade the reversal or maybe a continuation trend at 9 a.m. The candle closes, okay, are important, and we will also come back to them later on in the course or in the episodes. If the price wicks above a key level without closing above it, so top left, this indicates bearish movements because you simply grab the liquidity and market isn't pushing liquidity or volatility higher and breaking out of the candle, breaking out of a range. It's like digging a hole into a wall. You simply just dig a small hole in the wall, look through it, and that's it, and then you leave. If you want to break the whole wall, you have to get a bigger sledgehammer and crash the whole wall down because maybe, I don't know, you want to go through the wall. Conversely, if the price closes above that level, it signals a bullish trend. Okay, second or top right picture. Similarly, if the price wicks below a key level but does not close below it, the market remains bullish. However, a close below this level confirms the bearish sentiment. Okay, Cobraclay CRT models. And now here's a complete list of all the trading models that are out there. These are 13 models, step by step, and if you want detailed step-by-step videos where I break down each model and explain why they work the way they do, share this knowledge. And once we hit 10k views on, I don't know, this video, okay, I'll upload in-depth videos covering every single one and everything you will need to know. Let's make this happen and hopefully have 13 new upcoming videos where you then have 13 strategies or 13 models to look at, and you can choose whichever one fits best for you. The 3 orange models here are the 3 main models which I personally trade every single day. We have monthly models, which for those who are writing down the things may have already have some nice information about them in case where it forms the high or the low. Same goes for the weekly and the daily, which is my favorite. The 1 a.m. model, which is simple Asia grab, 2 to 5 a.m., 3 to 4 a.m., 5 a.m., 6 a.m., 9 a.m., the 30-minute and 90-minute models, 1 p.m. models, 5 p.m., and yes, the 9 p.m. model. Some things that I want you to avoid is PD areas hit. So if there's no PD area hit or if there's no key area hit, then you simply take no trades. Simple as that. Small consolidation before the second candle. For those who look closely, I may have already leaked it in the background of some files. Go back. You always need a small consolidation before falsely inducing above or below an old low. Okay, there can't be a consolidation to a reversal. It's not possible. Look at episode 1. The higher time frame premise has to be in alignment. So your daily candle, your weekly candle, your internal to external liquidity, your daily closes, and we will hop over weekly and daily bias in the next videos and episodes. And the candle closes of the previous candles as just mentioned, and 6 a.m. turtle soup validations. The 5 a.m. and the 6 a.m. turtle soup ain't the same. For a 6 a.m. turtle soup to be valid, you have to look at 1 hour time frame. This is explained in depth and will be explained in the upcoming 13 videos. Note that down. CRT will always be in alignment with the higher time frame order flow, and make a screenshot of that picture because that's the picture that I've mentioned a few minutes ago. CRT will always occur at the opening of a candle. So you here see a nice picture of small range, the opening or maybe even the middle of the candle in the first 20 minutes of a 1 hour candle, or the first 1 to 2 hours of a daily candle or a 4 hour candle. CRT will always be fast to accelerate. So you will have a liquidity grip, a falsely broken out of range, and then CISD and big push and fast acceleration, just like a rocket flying out to the atmosphere. CRT will always occur at a specific time. There's no Y without X and there's no X without Y. CRT will always be a false breakout. Okay, always. If it isn't a false breakout, then it's a continuation trade and not a CRT trade. So it's a continuation trade. CRT, or everything you look, is in the open high low close and open low high close. This step here is very boring, but 70% of the market is just consolidating and waiting. 30% is execution and taking trades. The structure of the candle, which digs into the key area, will show you where the markets will go. Dixie correlations, for those who need more clarifications, I will hop over that in the 13 videos about the trading models, and I also hopped over that and I had a nice example in mastering candle range theory. At times, the market may form a range on both EU and Dixie, but only manipulate the range on Dixie, leaving Euro unaffected. This phenomenon is known as SMT divergence or SMT correlations between the two pairs. In this scenario here on the bottom right, Dixie is the stronger pair and is likely to outperform EU. As a result, we can anticipate that EU will move in the opposing direction of Dixie, so providing valuable insights into potential market shifts and opportunities for strategic positioning. Here you see Monday forming a range, Tuesday not turtle souping EU's high, but Dixie turtle soups the low and then pushes to the opposing end of the range, where you could have entered also for sells in EU if you use the correlation. That's simply it for this episode. I hope you enjoyed it, and if you did, leave a like, get this video to 10k views, not likes, views, and I will see you in episode 3, where we'll hop over the fair value gaps and the weekly and daily bias. Enjoy, study hard, and see you in the next video.